Most people think investing is something you do after you've got a stable job, a savings account with actual money in it, and maybe a financial advisor on speed dial. But that's not true. You can start learning and building the habits of an investor right now, even if your bank account has nothing in it. So what actually is investing? At its core, investing means putting your money into something with the expectation that it'll grow over time. Instead of leaving your money sitting in a drawer losing value to inflation, you put it to work. The most common way people invest is through the stock market. When you buy a stock, you're buying a tiny piece of a company. If that company grows and becomes more valuable, your piece is worth more. If it shrinks, your piece is worth less. That's the basic trade-off. The potential for your money to grow comes with the risk that it might also lose value. Now, there's a concept every investor, beginner or expert, needs to understand: compound growth. It works like this. If you invest $100 and it grows by 10%, you now have $110. The next year, that 10% applies to $110, not just the original 100. Over time, this compounding effect turns even small amounts into something significant. The earlier you start, the more time compounding has to work in your favor. A teenager who starts investing at 16 has a massive head start on someone who waits until they're 30. But what if you genuinely have $0 right now? That's still a starting point. The first thing you can do is open a paper trading account. These are free simulated investment accounts where you practice buying and selling stocks with fake money. Platforms like Webull and TD Ameritrade offer paper trading tools, and they work exactly like real accounts. You just don't risk actual cash. This lets you learn how the market behaves, how to read charts, and how to make decisions without losing anything. The second thing is to start learning the vocabulary. Terms like ETF, index fund, dividend, portfolio, and market cap will come up constantly. An ETF, or exchange traded fund, is a bundle of many different stocks sold as one investment. Instead of picking one company to bet on, you spread your money across dozens or hundreds of companies at once. Index funds work similarly. These are considered some of the safest long-term investments because they track the overall market rather than the fate of one single company. Once you do have some money, even $20 or $30, apps like Fidelity, Schwab, and Public let you open accounts with no minimum balance and buy fractional shares. A fractional share means you can own a small piece of a stock even if the full share costs hundreds of dollars. You don't need to buy a whole share of Apple or Google to start. You can own a fraction of it. The most important thing a teen investor can build right now isn't a portfolio. It's the habit of thinking long term. Most people lose money in the market because they panic when prices drop and sell too early. Understanding that short-term drops are normal and that the market has historically trended upward over decades is what separates investors from gamblers. You're not trying to get rich overnight. You're building something slowly, consistently, and with patience. Starting with $0 isn't a barrier. It's just where most great investors began.